And surprise, surprise, even though we were promised that there would be world peace and internationalism and great harmony among mankind, the Europeans couldn't quite get their act together, and they defaulted on their debts. So the US, to say the least, was quite disappointed. And from the 1917, really, not even the end of the war, all the way through until the Great Crash, once again, the US economy was very uneven. There were parts of the US that went through what you all know as the Roaring '20s. You all remember the imagery from the movies and the news clips. But there were a lot of parts of this economy that were not doing well, particularly the farm sector. When the demand from Europe for US agricultural products slackened after World War I, so did the price of land. So did many other prices throughout our economy. The other thing which was going on during this time period, which a lot of people overlook, at least in the history books we have today, was technology and innovation. We electrified the entire country. Factories were electrified in Europe and the United States. Productivity increased. So by the time we're in the midst of the 20s, we had an abundance of goods and we didn't have enough demand. Does that sound familiar? Kind of reminds you of where we are today. So sure enough, FDR comes in after the great calamity in 1929 and does what he can to damage our economy further, if you'll forgive me for treating him with some contempt. I respect FDR as a war leader. I think he did a good job on that. But as an economic visionary and statesman, I don't think he did a very good job. The devaluation of the dollar, the other expedients that they put in place during that period, the seizure of the gold from private banks in the United States, I don't think helped us. If anything, I think it hurt us. I think it caused more deflation. And in particular, you know, if you read in the history books, they always blame the Depression on Smoot-Hawley, how the Congress in their wisdom in 1930, this is after the crash, the Congress finally passes tariff legislation to raise tariffs. But what everyone forgets is that tariffs had been high in the United States for 50 years before that. The Republicans, in their wisdom, had an average of 50% tariff on all imported goods because we did not want to let our workers and our industries be preyed upon by Europe, especially by England. They were more efficient than we were, and we said no. So comes World War II, and once again, the Europeans show up and say, hey, we need your help, we're going to have another war. Can you finance it? Can you help us? And of course we said yes. So once again, American industry, American agriculture benefited from the carnage in Europe. And we once again accumulated wealth, we accumulated industry, while we destroyed the rest of the world. If you think about it, think of a map in your mind. What parts of the world that had been industrialized were left after World War II? The United States. So from the end of the war on forward to today, how did we propel American economic growth? Well, we rebuilt the world very generously. We lent money, we gave money away, we helped our allies in Japan and Germany rebuild with free access to our markets, even though they protected their own, to help rebuild their own societies. That was the right thing to do, wasn't it? But then we had the Cold War. That was another good excuse to spend money, and particularly to borrow money. Because it is during that period from, say, the mid-60s on through the 70s, with the Nixon administration, that the US went from not merely being a cold warrior and spending a good amount of money on military, to starting to spend a lot of money on ourselves. And we went from the Cold War and a military confrontation as one of the drivers of our economy to housing, the housing industrial complex. Obviously, we needed houses for the soldiers when they came home. I lived in one in Washington, a little cottage in Bethesda, Maryland, that was built for a soldier and his family. Tiny little house. It was probably 2,200 to 2,300 square feet. But this was how we rewarded our soldiers. We took care of them, we educated them, we helped them buy homes. But that ethic of homes as a driver of national growth and employment carried on, right on to today. And I would argue that it was that focus on internal growth and internal consumption and away from manufacturing, which is very well represented in this community. This is one of the great industrial areas of the United States when it comes to metalworking, manufacturing. We somehow forgot that. We figured, well, we can focus on consumption, we can focus on spending money on ourselves, even if we have to finance it with debt. And our allies will grow their industries, grow their export capacity, and it'll all be okay. So here we are today, and I think we have to, and this is the reason I proposed this next paper to Jack, take stock a little bit of just what is the business model for our country? What is the model that we're going to use to provide all of you young people in this audience with jobs and your children with jobs? Because if it's just borrowing money and spending time building real estate, I think we're in a lot of trouble. That is not, to my mind, a valid way to preserve and grow, or at least stabilize national wealth. And yet, if you think about it, every time you look at the news, look at CNBC and all my other friends in the financial media, they talk about housing leading to recovery. Sometimes they even talk about banks leading to recovery. And I often say to them, look, banks are here to serve real industry. Banks are here to serve individuals and entrepreneurs and people who want to build things. They are, in fact, a reflection of their customers. Banks can't lead to recovery. A house is a place to live. Until 30 years ago, homes in this country were not speculative instruments that you would refinance every 3 and 4 years to take cash out. It was forced savings. You lived in the house for 30 years. When you were in your mid-50s, maybe your early 60s, you paid your mortgage off and you had a party, and your expenses fell. And then happy days, you could go off and do something else with the remaining portion of your life, and you were solving. You didn't have any debt. So we've turned that model on its head, and we've levered up this place where we live and turned it into essentially an option. And after pushing home prices up to the point where you need to have at least 2 incomes to buy the average house in the more expensive markets in the US, we've reached the limit. Home prices can't go any higher. And I think we all understand that. So to me, I think one of the things I want to explore next, working with NFI, is how can we rebalance the equation without embracing protectionism? How can we get people like China and these other countries that have been selling us goods for years and don't really let us have free access to their markets, change their behavior a little bit and maybe get some growth and some individual initiative in their own markets instead of depending on us all the time. And you know, the reason I ask all these questions, if I could come back to the issue of banks, which is what I spend my time on every day, if you think about why our banks are having trouble today, it's because more than 50% of their assets on their balance sheet have to do with housing. That is not a normal state of affairs. Now, there's a lot of reason why banks changed the business that they do. They used to lend to corporations. They used to lend for a lot of other things besides housing. And for deregulation, you had other competitors come into the marketplace. You even have big corporations who can finance themselves now. People forget that corporations are a bigger source of finance for our economy than banks. Cisco, General Electric, all of them finance their customers. They used to be able to sell that paper to investors. They can't do that anymore. All those companies now have to hoard their cash because they have to finance accounts receivable for their customers on their own balance sheets now. It's like 20 years ago. So the question I think we have to examine, all of us, and I'm going to be spending time on this in my research work, is can we come up with a model that enables our country to grow, that enables us to create jobs and opportunity for our people without imposing a beggar thy neighbor, anti-openness, anti-free trade regime on our allies, because they are dependent on us. Even countries that we might not consider allies. They have become very dependent on the United States as a buyer of their products. You see the Chinese now desperately trying to generate sources of demand, activity, however you want to describe it, in their own very controlled, very statist market, because their biggest customer has reduced expenditures rather considerably. If you think about what the Fed is doing right now, with low interest rates, none of our trading partners want to see the dollar go down. If the dollar goes down, the bonds that they hold in their banks and their central banks will lose value in their home currency. They'll take losses.